Now to Turkey. We've seen loan growth there soar after 4 rounds of interest rate cuts that sent consumers rushing for credit. But may not last, as firms have yet to join a debt spree that's been weighing on profit of state-owned lenders. Let's get a little bit more with our emerging markets reporter, Paul Wallace. Paul, good to see you. Thanks for joining Tracy and myself. So we could say that Mr. Erdogan got exactly what he wanted. Talk me through the numbers and put them in context.
Well, loan growth in Turkey has suddenly started to pick up, and in a big way. I think consumer loans are now up 45% year on year. Business loans are up about a third of that. And this is a change from the first half of the year when loan growth was down. Mm-hmm. And that was contributing to the economy really struggling. It was in recession at the beginning of the year. It's now come out of that, but it's still struggling very much. And it's predicted to basically be flat this year, i.e. to have zero growth this year. So Erdogan has really been trying to get the banks to turn on the taps. He wants to boost growth by ensuring that credit picks up, essentially.
Paul, it's Tracy Alloway over in Hong Kong. It's good to see you as always. I suppose the obvious question here is, can this kind of growth actually be sustained?
Well, that's a big question. It's soaring so much at the moment that a lot of analysts are saying it can't. One of the reasons this has come about is because the central bank has been easing in a big manner in the second half of this year. Since the beginning of July, it's reduced rates by 12 percentage points. It's halved its its base rate to 12%. Most global investors and analysts now think that it's pretty much come to the end of the line, that it can't go much further, because that's just going to put pressure on the lira. The real base rate in Turkey is now 1.4%, so there's really not that much of a buffer or a sort of a pickup for global investors. So if the central bank carries on easing without inflation falling in tandem, that's going to almost certainly put a lot of pressure on the lira.
Can we just talk a little bit about the markets? The lira is down 11%. We had a look at the bonds, the equities and the lira. The lira undoubtedly taking the brunt of the pressure of 12 percentage points change in rates. Credit aggregators say we've become too complacent. And I suppose 2020, it's about where could that complacency show? In the bond market, which is all about the carry trade, really, isn't it?
Yes. Interestingly, the lira has been incredibly resilient since the start of those rate cuts in July. Until the end of last week, it was pretty much unchanged against the dollar, and it was actually slightly outperforming emerging market currencies as a whole. It was almost sort of, if you like, it was almost a bit bulletproof. That has changed this week. It's down 2% against the dollar. It's now trading at about 5.92. So it seems as if perhaps its resistance is waning now, and we are starting to see lira weakness, and perhaps that will continue in 2020. We do have some sort of wild cards out there. One of them is what the US does in terms of sanctions. If it decides to place them on Turkey for its incursion in northern Syria and other things, such as buying advanced missile systems from Russia, that's going to be extremely bad news for the lira.